Hi everybody, this is Ellman, the blue collar investor. I just got back from the gym. I had a great workout and I'm all energized now to do another Ask Alan video. So today's covered call writing question of the day comes from Manohar of Alpharetta, Georgia. Manohar writes, Alan, I'm beginning to get the hang of these options thanks to your education series. I have a question on rolling options. What criteria, timing and strikes, do you use when rolling out? Specifically, do you roll out a week before the expiration date? And is there any time when a certain other criteria should become apparent? And if so, which ones? And finally, do we roll out until we find an expiration date and strike price that will result in a net credit? Manohar, I'm really glad that you asked this question because rolling strategies are critical to maximizing our covered call writing success. I use this strategy all the time. First, for our viewers that are not familiar with rolling strategies, let's define it. As you can see on the screen, rolling out is when you close an options contract at a near-term expiration and open the same strike contract at a later date. So, you would close a January 30 contract and open a February 30 contract as an example. Now, let's talk about some of the general criteria that have to be in place in order for rolling out to make sense. And take a look at the screen and you will see some of the general criteria. First of all, the stock still has to meet all of our system criteria. That includes fundamental, technical, and common sense principles. In addition to that, it's very important that there is no upcoming earnings report in the next month. As you know, in the BCI methodology, we never sell a covered call option if there's an upcoming earnings report. In addition to that, the calculations must meet our goals for that month. Now, my goals are 2 to 4%. So when you calculate the debit of buying back the option and the credit of selling the next month's option, it has to have a return that meets your financial goals. And finally, for it to make sense to roll out, the current market value of the stock has to be likely to end up higher than the strike price that you sold. If the current market value is less than the strike, the option will not be exercised. You may as well let it expire worthless, and then you could sell the option the following Monday or Tuesday if you decide to keep that stock. So those are the general criteria. Now let's get into some specific ones that you asked about in your question. And once again, on the screen, you'll see my responses. As far as when I roll out, I try to roll out as close to 4 p.m. Eastern Standard Time on expiration Friday. The reason for that is the time value of the option will be approaching zero. Maybe it'll be 5 or 10 cents. The next month's options premium will not be impacted at all by waiting another day and close to 4 p.m. expiration Friday. So the credit will be a little bit greater the closer you get to 4 p.m. on expiration Friday. However, if you can't get to your computer or you're not going to be available to roll out on Friday, doing it on Wednesday and Thursday is really no big deal. Now, as far as when there'll be a net credit, there will always be a net credit for the following month. The intrinsic value of the option premium, or the amount that the strike price is in the money, is the same for this month's and next month's option. What will differ is the time value. And as I said before, the time value on the near month will be approaching zero. It'll be much more substantial for the following month. So when you calculate the debit for buying back the option and the credit for selling the next month's option, there will always be a net credit for the next month's option, something you don't have to worry about. Now let me give you an example. If we had sold the $30 strike and the stock near expiration Friday 4 p.m. Eastern Standard Time is at 32, that strike price is $2 in the money, or has $2 of intrinsic value as far as the premium is concerned. Now the time value will be 5 or 10 cents. Let's assign a value of 10 cents to it. So to buy back that option, it's going to cost us $2.10. Now, if we look at the next month's $30 strike, the intrinsic value will still be $2, and the time value will be significantly more because we have 4 or 5 weeks until the option expires. So let's assign a time value of $1.10 as in this hypothetical. So to sell the next month's option, we would then generate a premium of $3.10. Now, if we took the debit of $2.10 and a credit of $3.10, we end up with a net credit of $1 per share, or $100 for the contract. Since our shares are currently worth $30, our agreed upon option to sell, and that's our obligation to sell, then our 1 month return is 3.3%. That profit is protected by a downside protection of 6.3%. We get that by taking the $2 of intrinsic value and dividing it by the current market value of the stock, $32. So what that means is our 3.3% 1 month return is guaranteed as long as our shares do not depreciate by more than 6.3% by expiration Friday. Now bear in mind, we're not talking about break even. We're talking about protection of the initial option profit. So there you have it. You could see some of the advantages of rolling out, when we should roll out, and how to calculate the profits when we roll out. Manohar, it was a great question. I really appreciate you asking it. I appreciate all the viewers for watching this video. I hope you feel you benefited from it. And as always, this is Ellman, the Blue Collar Investor. Take care, everybody.